Hi, Mr. Market here. So, the Federal Reserve, it's a name that might make you think of dusty old history books or complex financial jargon that seems far removed from your everyday life. Sounds like a boring history book, right? Think again. The Federal Reserve is anything but boring. In fact, it's one of the most crucial institutions in the US economy. This group of economists and bankers are like the conductors of a giant chaotic orchestra, except the instruments are banks and the music is the US economy. They make decisions that affect every single one of us, whether we realize it or not, and sometimes, instead of a baton, they use something far more powerful: interest rate cuts. These decisions can send ripples through the entire financial system. Now, you might be thinking interest rates, that's more boring than watching paint dry. But hold on, because these rates are more important than you might think. These rates are a big deal. They can determine how much you pay for a mortgage, the interest on your credit cards, and even the returns on your savings. They influence everything from how much you pay for a mortgage, which can be the difference between buying your dream home or settling for something less, to whether or not that fancy coffee shop down the street can afford to stay open. Small businesses rely on loans and credit, and interest rates can make or break them. The Fed doesn't just set interest rates for kicks. Every decision is carefully calculated to balance the economy. Their main gig is to keep the economy humming along nicely, which means controlling inflation, the bad kind of price increases, so that your money retains its value, and keeping unemployment low, because nobody likes being unemployed. High employment means more people have money to spend, which keeps the economy vibrant. So how do they do it? How does the Fed manage to keep this delicate balance? Well, that's where things get interesting. The Fed has a variety of tools at its disposal, each designed to influence the economy in different ways. From open market operations to the discount rate, but one of the most important is its ability to cut or raise interest rates. By adjusting these rates, the Fed can either encourage borrowing and spending to stimulate the economy, or discourage it to cool things down. It's a delicate dance, but one that has profound impacts on our daily lives. The Federal Reserve, often referred to as the Fed, is like the wise old sage of the US economy. It stands as a pillar of financial wisdom, guiding the nation through the turbulent waters of economic uncertainty. Instead of cryptic riddles, they use monetary policy to guide us towards financial stability. These policies are crafted with meticulous care, aiming to balance the scales of economic growth and stability. Their decisions have a ripple effect, influencing everything from interest rates on loans to the overall health of the stock market. When the Fed speaks, the financial world listens, and markets react almost instantaneously. One of the Fed's primary goals is to control inflation. Inflation, if left unchecked, can erode the value of money, making everyday goods and services more expensive for everyone. Think of inflation like a party guest who just won't leave. Initially, it brings excitement and energy, but over time it becomes a nuisance. It's fun at first, with prices going up and everyone feeling good. People are spending more, businesses are thriving, and the economy seems to be on a roll. But let it linger too long, and it overstays its welcome, eroding the purchasing power of your hard-earned dollars. Suddenly, the cost of living increases, and your money doesn't go as far as it used to. To combat inflation, the Fed might raise interest rates. This is a strategic move to cool down an overheating economy. This is like turning down the music at the party. The excitement fades and people start to leave, bringing the atmosphere back to a manageable level. It slows down borrowing and spending, which helps to cool down the economy and keep inflation in check. Higher interest rates make loans more expensive, discouraging excessive borrowing and spending. On the flip side, when the economy is feeling a bit sluggish, the Fed might decide to cut interest rates. This is a tactic to stimulate economic activity and prevent a recession. This is like turning up the music and adding more snacks to the party. The energy picks up, and people start to enjoy themselves again. It encourages borrowing and spending, providing a much-needed boost to economic activity. Lower interest rates make it cheaper to borrow money, which can lead to increased investment and consumer spending. The Fed's actions are a delicate balancing act. They must carefully consider the timing and magnitude of their decisions to avoid unintended consequences. Critics argue that the Fed's interventions can sometimes do more harm than good, potentially leading to market distortions or financial bubbles. However, supporters believe that without the Fed's guidance, the economy would be far more volatile and prone to severe downturns. Whether seen as a money maestro or a market manipulator, the Federal Reserve remains a central figure in the story of the US economy, wielding significant influence over the financial landscape. Rate cuts are often seen as a good thing for the stock market. They can act like a shot of adrenaline, giving the market a much-needed boost. Lower rates mean companies can borrow money more cheaply, which can lead to more investment, more growth, and hopefully higher stock prices. When borrowing costs are low, businesses are more inclined to take out loans to fund new projects, expand operations, and hire more employees. Think of it like this: you're a company and you want to build a new factory. This factory could increase your production capacity, allowing you to meet higher demand and generate more revenue. You need money, so you go to the bank for a loan. The bank evaluates your business plan and decides to lend you the money, but the interest rate they charge will significantly impact your decision. If interest rates are high, that loan is going to cost you an arm and a leg. High borrowing costs can deter you from taking the loan, delaying or even canceling your expansion plans. But if the Fed cuts rates, suddenly that loan is a lot more affordable and you're more likely to build that factory, hire more workers, and make more money. This can lead to a ripple effect throughout the economy, as increased business activity can boost overall economic growth. But hold your horses. Rate cuts aren't always a slam dunk for the stock market. While they can provide a temporary boost, they're not a guaranteed solution for long-term growth. Sometimes the Fed cuts rates because the economy is looking a bit peaky. This means that underlying economic conditions might be weak, and the rate cut is an attempt to stimulate growth. And if the economy is weak, that might mean companies aren't doing as well, which could actually lead to lower stock prices. Investors might be wary of putting their money into stocks if they believe that economic conditions will continue to deteriorate. It's like trying to fix a leaky faucet by turning up the water pressure. The increased flow might temporarily mask the problem, but it doesn't address the underlying issue. Sure, you might get more water flowing, but you're also making the leak worse. Similarly, rate cuts can sometimes exacerbate economic problems if they are not accompanied by other measures to strengthen the economy. It's a delicate balance that requires careful consideration and a comprehensive approach to economic policy. Case studies. When rate cuts made companies sing or cry. Let's look at some real-world examples of how rate cuts have affected companies. Amazon. When the Fed cut rates in 2020 to combat the COVID-19 pandemic, Amazon, the e-commerce giant, saw its stock price soar. Lower rates fueled consumer spending, which meant more people were clicking that Buy Now button on Amazon's website. ExxonMobil. On the other hand, ExxonMobil, the oil and gas behemoth, didn't fare so well when the Fed cut rates in 2019. Lower rates often weaken the dollar, making it more expensive for companies like ExxonMobil to buy and sell oil internationally. Ford. The automotive industry, including companies like Ford, is highly sensitive to interest rate changes. Lower rates make it cheaper for consumers to finance new car purchases, boosting sales for car manufacturers. These examples illustrate how rate cuts can have a mixed bag of effects on different companies and sectors. A roller coaster ride, recent rate hikes, and the market's mood swings. Remember that whole keeping inflation in check thing we talked about earlier? Well, in recent years, inflation has been about as welcome as a skunk at a picnic. To combat this unwelcome guest, the Fed has been raising interest rates like it's going out of style. These rate hikes have been like a roller coaster ride for the stock market. At first, investors were nervous about the Fed's plans to raise rates and the market got a bit wobbly. But as the Fed continued to hike rates, the market seemed to take it in stride, with stocks reaching new highs. However, as the pace of rate hikes accelerated, the market started to get a bit queasy. Higher rates make it more expensive for companies to borrow money, which can eat into their profits and make investors nervous. The Fed and the stock market, a love-hate relationship. So what have we learned? The Federal Reserve and the stock market have a complicated relationship. It's a bit like that couple you know who's always fighting, but they can't seem to live without each other. Rate cuts can be like a shot of espresso for the stock market, giving it a quick boost of energy. But too much caffeine can be a bad thing. And rate cuts can also lead to inflation and other problems. Ultimately, the Fed's goal is to keep the economy in balance. And that means sometimes making tough decisions that might not make everyone happy. So the next time you see a headline about the Fed cutting or raising rates, don't just scroll past. Pay attention, because what they do can have a big impact on your wallet, whether you're a seasoned investor or just trying to make ends meet.